Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, June 19th, 2019. What I wanted to do in this video is cover commodities. In particular, we're going to start out with the agriculture or soft commodities. Time permitting, we'll get to the hard commodities. Soft commodities are those typically which are grown. So you have all your, cotton, soybeans, wheat, that kind of stuff. And hard commodities are anything that comes out of the ground, oil, industrial metals, things like that, gold, of course. So now I'm starting out here with the stock market because today is Fed Day. I'm going to just keep it very brief. I'm only throwing this in there because we do have the FOMC announcement today. The only thing I can guarantee after the announcement is some volatility picking up. I'm considering pulling stops, or suspending, I should say, suspending stops on a couple trades that are close, such as QQQ and I think TVIX. I'll have to take a look at that one. I haven't even checked today. But this still remains my preferred scenario. And of course, again, you're going to get some initial knee-jerk reactions, and that either plays out or it doesn't. But we do have the nice bullish divergences, negative divergences in place. Recently that was my alternative scenario, which became my preferred due to that Trump pump with the we had a tweet from Trump and then the dovish statements from Mario Draghi and the ECB. So that's what we're looking at right now. That's how the charts look. And again, I'm going to focus on commodities for a couple reasons. Number one, I see opportunities there, and I also think this is very, very important, and that is asset allocation. I talk about it quite a bit. You've probably noticed, if you've been with the site for any period of time, a good percentage of the trades, really going back into 2018, have been things other than stocks or other than the stock market. We've had treasury bonds. I've covered those quite a bit. We've had long side trades on treasuries, both official, unofficial. Same thing with gold, and then various agricultural commodities, coffee, wheat, things like that. So I think it's very, very important. In fact, I know it is. Studies show that asset allocation, let's just talk about that real quick. Asset allocation, here's a chart right here. This is just a Google search for asset allocation. Click on images and you're going to get all these pie charts. Remember, my background comes, I used to be in my former life a financial advisor, stockbroker, and this is, study after study that I've seen and come across show you that asset allocation, and they've done studies across professional money managers, individual portfolios, has a bigger impact on your total returns than does security selection. So in other words, a great stock picker who might be, that's all they focus on, will underperform over time for against a portfolio with proper asset allocation, diversification. What does that mean? These pieces, this is just one I clicked on. You can, see the kind of the gist of it. And I go over this because a lot of the folks coming in, if you come off the YouTube channel, most of what you're going to hear from me is general stock market analysis. Why is that free content? It's a dime a dozen. Not that mine's any better or worse than anybody else's, but there's a lot of it out there, and it is a small piece of the pie. Now, when we get down to doing actual trades on indexes or anything like that, then I'll refrain from sharing the price targets, things like that. But the stock market as a whole can be a lot tougher to call than individual commodities, individual sectors, individual asset classes such as bonds, or such as, let's say, treasury bonds. Why is that? Well, the stock market per se consists of thousands, tens of thousands of securities in all different industries, some going up any given point in time, some going down, different sectors. So therefore you have just a mishmash of a lot of different things that just happen to fall under the designation equities or stocks. So this is what, not that these percentages, but this is what a portfolio should look like. Whether you are a swing trader or, and this is again my opinion here, guys, whether you're a swing trader or an investor, and what that says is don't put all your eggs in one basket. That doesn't mean don't put it all in one stock. It means don't put it all into one asset class. So for example, you might have half your money in index funds, right? Let's say SPY, QQQ, or S&P 500 index funds, and then you're buying Apple and you're buying Amazon and other things. You are giving yourself 100% overlap because the top components of the index funds, QQQ, SPY, are Amazon, Apple, Microsoft. So you think you're diversified, but you're not. So this is the key right here, and you can see Again, this is a little fancy talking about hedge funds and all this, but the fixed income. So there's your bonds, and then you further break that down by how, in what I call strategic asset or tactical asset allocation, how much of that will be into junk bonds, if any, how much into investment grade corporate bonds, how much into treasury bonds, and maybe muni bonds. So that's what those models look like. And over time that will shift, and that's what I try to do both on this site and my own investments personally. So international equities, sometimes international stocks are outperforming US stocks, sometimes the other way around, and within there you slice that down too, and you have your emerging markets as a part of the international equity pie, and you have your developed markets. Some do better at sometimes, and others do better at different times. So that's all part of asset allocation. And let's move on here and take a look at some of the different charts right now. Again, in particular, we're going to focus on we'll start here with the soft commodities because that's where I have the majority of the charts. Time permitting, I'll get to the hard commodities such as timber, natural gas, and crude oil, things like that, and gold and everything. But not in this video. I'll probably keep gold separate. All right, so this is the one of several indexes out there. This is the Bloomberg Soft Sub-Index. So softs are, again, soft commodities, as I said, are those that are typically grown, not pulled out of the ground like metals and oil and stuff like that. And you can see, and as you know, that's where a good part of so far this year my focus has been, and on and off over the years. So the big takeaway, we're looking here at a chart going back to the 90s right here. If you look down on the very bottom, you can see each year. So this goes back to the late 90s, and overall commodities have been in a bear market, a secular bear market, but there are some powerful bull markets within there to trade. I use log scaling, so don't underestimate the move here. Some of these rallies, they're well into the double digits, sometimes triple digit gains in percentage terms. So you have at the bottom of the scale about $30, up high 115, and that's what log scaling will do. You see what it attempts to do when you use log scaling, it'll put all the candlesticks proportionate in percentage moves. So you have a 10% move on a $30 security, it's going to go up $3. You have a $3 move on a $100 security, that's only 3%. And so log scaling will correct for that huge disparity when you're looking at these long-term charts. And in my opinion, an absolute must to use log scaling on a 30 plus year chart like this. So you can see that well, let's just look at the takeaways here. A lot of the lines are already annotated. You can see here we have a couple divergent lows, divergences when you have prices, positive divergence when prices are falling and your indicators are rising at the same time. So you had, for example, a divergent low right here on just the PPO, and then boom, a big rally that I'm sure was well into the double digits, if not triple digit gains there. And then we continued lower after that rally. It was certainly a tradable rally, and again, it's a long-term chart. That was about a 1-year rally there. So you could swing trade, trend trade it, and like I would say, give me bull market, bear market, doesn't matter, because the bear market rallies within a bull market are very profitable and lucrative to trade, as are as the other way around. During a bull market, the corrections can be very profitable to trade too. So then we put in, as you can see, we made another low after that. And we had some pretty strong divergence on the RSI, and that's set up for this move here. And in fact, I'll tell you how much that was. So that was, you can call it a bear market rally if you want. We'll measure it up here. You can see the to the left there. That's a 207%, 208% rally right there off that divergent low. So again, the point being, bull market, bear market, doesn't matter. Trade the charts, because you'll find cyclical bull and bear markets within a secular bull or bear market. Secular means a longer term trend, and these are your cyclical bull and bear markets. So that's it. And I guess the takeaway is where I'm leading to, as you can see right here, we have some very strong, in fact, these are, other than I missed one right here, there should be a divergence line there. We had nice, about comparable divergence. When I say comparable, about both the length or duration of those trend lines as well as the slope was very comparable to back here and leading up to the early 2014 lows. And we had back then just a beautiful bullish falling wedge pattern. And you can see what happened. That was a bit nice, easily well into the double digit gain rally right there. So these are the trading ops that we look for. Wash, rinse, repeat. Look for these divergent lows to position long for the rallies, just as we had. In fact, this one hasn't even broken out. So as much as we've already come off the bottom, come up, there's plenty of upside, I believe. And I think I feel pretty confident in my views, whether I'll be wrong or right, that the outlook for the stock market, I've been saying this for a long time, and that's held up, is very poor. The market's gone nowhere now for, what is it, over really almost a year now. It's hardly gone anywhere, just a couple percentage points on the broad market. So, when I say the risk reward is poor on the long side, it doesn't mean you have to crash right away. And we've had some pretty good corrections, but I maintain that view that the risk reward or the upside potential in equities is not very favorable at this point. And I think that's even an understatement, but let's just say not favorable. And I think it is very, very favorable in the ag commodities. So you're going to continue to see trade ideas. And again, whether they're official, unofficial, I won't share an idea if I don't like it. Making it official is just finding the time to get down. Sometimes to hone down on an objective entry. Gold, for example, I've talked about a lot in all year and even into last year. And I've listed many different objective entries or scale-in points. And I've been waiting for some developments on the dollar to occur to give me the higher degree of confidence to add that as a long-term trade. But like I said, I've had positions I've been building now for months and can plan to continue to build. And we may or may not add that on as an official trade idea soon. But I think, again, it all comes back to that piece of the pie. There's your portfolio. Right now, your sliver in gold might look like this. It might look like that. And later on, it might look like that. And that's, kind of the way I'm thinking is if the charts firm up, I'll continue to add to that portion. And then I may or may not have, treasury bonds. I may have, short stocks. Let's say that's equities, but those are shorts. And I may have longs here, things that might outperform in a down or a bear market or a sideways market. And other things over here, natural gas, oil, wherever the opportunities are. Maybe it's Bitcoin. I don't care if it has a ticker and I can chart it. I'll trade it, and you'll see those trade ideas on the site. All right, so that's that. And again, you can see here, just like all these other divergent lows on the chart, and downtrend line breaks, that will trigger a longer term buy signal once that breaks out. But from the look of this, it's pretty. I think it's pretty much. You can't use the word inevitable, but I just think highly likely that we're going to be looking at a pretty strong rally in the softs. Another thing that plays in fundamentally is, although the central banks have already subtracted some of the liquidity that they put into the market with the quantitative tightening, as we all know, things are now going back the other way. They're talking about, the ECB is already talking about doing more quantitative easing, expanding their bond buying program. The U.S. is talking about possible rate cuts this year. So what I'm getting at is there is still a tremendous amount of liquidity sloshing around the system, and it's going to find a home somewhere. Stocks are overvalued. They are overvalued by just about all historical standards, and the economy is starting to show weakness. So I think there's value here in the softs and these commodities, because remember, these don't go to zero. Cotton, oil, they don't go to zero. They don't file for bankruptcy. There's never corporate fraud, in the ground on oil. Oil is always going to have its value, as will cotton and soybeans, things like that. And so enough on that. I just wanted to again try to impress the point that if you're not looking to include these in your portfolio, I think you're missing out. It's not exciting. Nobody, you go down, have a few beers with your friend at the bar. You're going to talk about Apple. You're going to talk about a little biotech stock that's going to fly. Those are exciting. Everybody wants to talk about the stock market and stocks. Nobody wants to talk about soybeans, but you go out to a mixer in the Hamptons and rub elbows with hedge fund managers. That's what they're talking about. That's where smart money will move into when things don't look good in the stock market. So enough on that. Let's look at the rest of the charts, and I'll fly through these pretty quickly because I need to. I have a lot of charts to cover, and I don't want this video to go too long. So there's the longer term outlook. Let's look at a daily chart here. Let me pause this. Again, this is just the index itself, and there are ETNs out there and ETFs that will track various commodity indexes or baskets of different commodities, and sometimes I'll add those as trade ideas. I'll even get to one here in a second, DBA. But this is just zooming in. We were looking at that long-term chart. This is what it looks like on a daily chart for the Bloomberg Soft Commodity Subindex. So you can see the divergence, and you can see a little whipsaw here. But again, go off that weekly chart, and it shows you a pretty clean trend line. So it's looking pretty good for a nice bull run here in the commodities. Where would it go? I think right at minimum up here, about that 38, 39 level. And again, that's the index as a whole. What would that mean in percentage terms? Well, if we broke out today or anytime soon from around these levels, you're talking about a 26, 27% rally up to that level. Probably about 38 or so up to my next target. Should we go down and have another thrust in the wedge? Sure, these divergences will be intact. We're certainly in a downtrend now. You can't argue that. So going, aggressively long right now is a bit of an aggressive counter trend trade. So it's just something we'll kind of, and what we are doing, I'm tactically going into these. I'm not doing a broad-based, let's go put all our money in a commodities fund or commodities ETF, because they're all different. For example, grains go up, and usually you see the cattle, livestock, pigs and cattle futures fall, because that's the biggest expense to the farmers. They got to feed the cows and the pigs. They got to feed them grains, corn, wheat, soybeans, that kind of stuff. So that's why I'm not a big fan of the broad-based, one-size-fits-all commodity. I'd rather go in and selectively handpick, those that have the best-looking charts and avoid those that don't. Okay, here's one of those funds, somewhat of a one-size-fits-all, but not exactly. This is DBA, Invesco Agricultural Fund, and it holds ag commodities. So it doesn't have it doesn't have your hard commodities. You're not going to have oil, nat gas, gold, aluminum, things like that in here. So it is more of a direct play on the ag sector. But as I said, and I haven't updated this in a while, but as you can see here, it was back in 2018, so it's been over a year. This changes somewhat, but not too much. You kind of get the idea of what it's holding here. It has a big concentration in the grains. In fact, that's the bulk of it right there, wheat, corn, and soybeans. And then, as I said, you have cattle, hogs, things like that often will, although right now, believe it or not, I'm not so keen on hogs. Somebody asked me about it the other day in the trading room, but cattle's looking pretty good. We'll try to get to that chart in a second. So again, there's always exception to the rules as far as correlations between two different asset classes, but there's kind of an idea. So these are the things we're going to be covering today: wheat, corn, soybeans, cattle. I'm going to skip cocoa. I don't have a big opinion on it right now. We'll hit on sugar, coffee, and cotton. So, and again, if you are in for simplicity, and there's certainly nothing wrong with going with something like DBA, where you say, okay, that makes sense. I would like to diversify. I think it's a good time to do so. Put, 10, 20, whatever that percentage is into agricultural commodities. Boom, there's a benefit, or at least, there's a benefit in being one and done. Something very easy. You have you don't have the commissions to pay for if you're trying to, trade a basket of 5, 6, 7 different individual commodities. Just one trade, and you have some pretty good exposure to the commodity sector. Ag commodities, those are, and as well as the benefit of asset allocation in your portfolio, which means maybe the stock market goes down, or your stock holdings, whatever they are, or your gold, and then these ag commodities are going up, and vice versa. That's the whole benefit to that whole pie chart thing I did. Is that it's like, I use the analogy, I know I'm probably older than most people listen to my voice, but before the days all this electronic emission and all that, you had an old 8-cylinder car. My first truck was an 8-cylinder truck. If you could have one of those cylinders go out, you could even have 2 cylinders go out, and the truck's still going to run. It might sputter, might backfire a little bit, but the engine's going to run, and that's the point of asset allocation. You're running a 1-2-cylinder portfolio, one of those cylinders go out, that engine's not going to run. It won't start, it won't go. So the more cylinders you have, the better it is. Your portfolio will be 1 or 2. If in other words, it's the old expression, if you're not firing on all cylinders. So that's my kind of analogy for asset allocation. Okay, got to get off this chart, but I have a lot of different variations of the same chart, and this is that same Bloomberg soft sub index, and the weekly chart again, and you can see some targets here as well. So I just wanted, you can screenshot that again. That's a weekly chart, and there's probably an ETF that trades that index. I would imagine. I'm not aware of one offhand, but I'll check into that. Okay, let's roll into some of these individual ones. This is cattle. Not really one of my favorites right now, but actually might be good for a bounce here. I'll point out, you can probably see most of my annotations where it's going. All right, so trading, and especially look at each commodity, each individual security you're trading, because they're all different, but for the most part, like this chart, and we're going back for years here, couldn't get any easier. For example, if you're long and you're trying to catch the bulk of a trend, or you're looking to get short, just look at the top here on the RSI. And then I didn't miss any reading. I've missed one right there. But other than that, okay, so I've got them all right now. Simple stuff. Stay long. Well, I'll tell you, it's not that simple. There's more that goes into the technical analysis. You want to align things with charts. But if you look at all these circles here, we started to get overbought there, continue to get overbought. And so I'm just going to circle these overbought readings that we have right here. Again, anything 70 or more on the RSI. And I think you see where I'm going. That's when it doesn't necessarily mean that's a sell signal short right away, although in many instances it was. Just look what happened after we got those overbought readings. And at the very least, just like the stock market, when I'll warn, or anything else where the risk reward just isn't attractive. Yes, the trend is bullish, and this is where you get those trend chasers. They say, the trend's your friend, and blah blah blah, and you ignore these simple readings like that. And at the very least, you don't have to short just because you're overbought, nor should you. You need to see other things to go short or reverse out of a long, such as breaks of support, trend line, bearish reversal, candlestick patterns, things like that. But it's pretty easy with even if you shorted or got out on the very first overbought reading and gave it a little room, in every case you would have made a lot of money shorting. So take that as you want. Same thing with these overbought readings. I could sit here and do the same thing, and I'm not going to do it on every security, but I will here because we have the levels circled. Oversold when you hit 30 or more. That's the lower line. Pretty simple wash, rinse, repeat stuff. Now, where am I going with this? Of course, there's leading up to where we're at today. Not only are we oversold, but we have positive divergence as well. We had a divergent high here. That was a big sell signal because we had a very well-defined trend line. And this is just a beautiful example of technical analysis, as most of these charts are. Here's your uptrend line. That's your bull market uptrend line off that last oversold reading. Here's your divergence. You started having negative divergence from this point there on the PPO, from here on the RSI. So you had a divergent high, and at that point you should have been on the lookout for a sell signal. You got the sell signal when we broke the trend line, and then boom, nothing but a waterfall sell-off in cattle prices right there. And now we've come full circle. We are oversold, deeply oversold. The last time we were this oversold, again, look at those orange. When you go under the 30 level, it's colored orange. This is the only time we were that oversold in years, and look what happened from there. So we're deeply oversold with bullish divergence. So cattle, like I said, despite the fact I'm bullish right now on the grains, it is usually I'm not bullish on cattle as well, and that's also why I'm a little bit skeptical. Well, I don't have a long position here. Probably won't add that as a long, but did want to share it because it could play out for a bounce, or since this was a pretty big sell signal, what may happen is we may just get a muted bounce, and we may come on down and continue to diverge for a while and then hit support. So I can tell you right now, I would be more comfortable in adding cattle is a long trade idea, or going long personally. If and when we come down, you can see a pretty good support zone right here. These two lines there, either 62 or down at the bottom of the zone around 61. So that's cattle. Soybeans are just a very tradable instrument. Again, it's nothing you're gonna talk at the office. Most people aren't talking about soybeans. Again, they want to talk about the tech stock du jour, or Bitcoin, or something else like that. But just a lot of money to be made. These are all notes. These are charts that have been posted in the past, notes at the time, and you can see that in most cases we've had a lot of trades on soybeans in the past, and a lot of those have been very profitable. You can see how well it trades. You see these the positive divergences that I look for, oversold readings, same thing for reversing or going short, extreme overbought or yeah, extreme overbought readings right there, mark highs. So where are we at right now? Well, we have bullish divergence here on the MACD. I might have another chart with a PPO. PPO will look very similar. We're coming off extreme oversold readings. As I said, oversold in itself isn't always a buy signal. In this case, we had divergent low. We had oversold followed by another near oversold reading right there, put in a divergent low, and then boom, nice rally. We've come on down, and now we have the divergence here on the MACD and as well as the PPO. Here's a longer-term downtrend line that would be quite bullish if taken out. But right now, the way I view soybeans is clear out those annotations. You can see what looks to be like a basing pattern right here. We've been moving around in this basing pattern. I believe it's a bottoming pattern. The divergences, the oversold readings tell me, and the fact that I just showed you. Remember, I started with an overview of the entire soft commodity index, and they all look poised to either for a significant bear market rally or quite likely the end of the cyclical bull market is what I think. In that way, you can position for these and tuck some of these trades away for years if you like, if you don't want to try to actively game the rips and dips. So that's it. Basically, a pop over the recent highs right here should do the trick, run us up to that trend line, and ultimately a breakout above that trend line would be quite bullish. So that's soybeans. That is if I don't make mention, guys, I'm covering daily and weekly charts, and it's usually up here at the top. Also remember, these are futures charts, and on stock charts they give you the end of day prices. So these are all yesterday's closing prices if it's you see a dollar sign in front of the thing. The only thing I think that I covered or will cover was that DBA ETF. If I get to LIT, which is lithium, those are hard commodities. That's also an ETF, so that'll have real-time prices. Okay, in bigger picture, I always like to look at the weekly charts and the daily charts. This is soybean. This soybean price is going back to 2004 here on the left of the chart. So this is a weekly long-term chart, multi-year chart, and we had a bull trend here in soybean prices. The top was telegraphed well in advance, just like back here. I don't have all the annotations on this chart, but you can see our negative divergence right there. I'm drawing it on the RSI up above, the PPO down below. Divergent high said, get out of that trend. You're going to have a trend reversal. Boom, and you had a big correction. Right here, same thing. You had a big divergent high, negative divergence on the indicators, and boom, that marked the top. And you can see just again, these ag commodities trade every bit as well to the technicals as stocks do, or any other security. Breakdown, back test, another back test at higher level, and then boom, that was it. I mean, the top was right here, so this was the beginning of a downtrend. There's our downtrend line. So that's what we need to break on soybeans for a much longer term buy signal. Again, this is a weekly chart, and we had back here. At the time, we were right here. When I had a dotted line, I was forecasting that this would happen. Well, I would have posted this right here saying I expected another thrust down to put in a divergent low and then a reversal here, and that's exactly what happened. And you can see the rally that came after. So sometimes I'll lay these things out in advance before I'm actually bullish or taking a position. And sometimes I'll follow up, sometimes I don't. So I recommend to replicate these charts. If you're a member of the site, let me know, especially if you have a stock charts account. I can give you a permalink and share these charts with you. If you don't have an account, there's certain time periods they won't let you view. The chart will open up, but if you do have an account with them, you can save these charts as your own, have all the annotations on there, and again, just drop me a line and I'll post it in the under this post in the comment section. So here we go again. Divergent low, nice clean positive divergence on both the PPO and the RSI, and I expect this time around. See, this is what you have to take into consideration. Last time around, it gave me the rally I was expecting, but that wasn't really, at that point in time, I couldn't make the case for a bottom in soybeans and a much longer rally. Why? Well, number one, we just came off a bull market with a major sell signal when we had the breakdown and backtest, big divergent high. Now we've corrected quite a bit. There's been a bear market in soybeans, and if these divergences play out now, which I suspect they will, that will play out for a breakout. This would project that we're going to go above that trend line. Then that gives us a longer term buy signal, and which may be a a major bottom in soybeans, or at least whether it's the end of the cyclical or secular bear market or not. Even if you get a 30, 40, 50, 80% rally, 100% rally, it's worth trading in my opinion. So whether bull, bear, I don't care. Right now the charts look constructive to me, and I think there's more upside, and really that's all that matters at this point in time. Here's sugar looking pretty sweet longer term. This is a weekly chart. You can see goes back to 2002, and similar. A lot of these ag commodities, although soybeans and sugar have absolutely nothing to do with each other. They usually don't even grow in the same. No, they don't grow in the same exact climates. But you can see this is similar to that chart of soybeans we were just covering, where you had a bull market uptrend line. It ended with, you got it. It didn't have it all marked here, but there's your negative divergence. That told you to get out of sugar at the time, or at least. Yeah, well, pretty much get it. When you see a big divergent high like that and then a reversal, that marked the top. And we broke down just like soybeans, back tested just like soybeans, continued lower. We had a rally around the same time soybeans rallied right here in 2015. That rally was well telegraphed in advance with bullish divergences building here, and that was a big rally in sugar. Don't underestimate just how far these ag commodities can run. I'm going to measure it out for you right there from the low to the high. That was I think it was said 130% rally. Yeah, 135% rally, and that was in what, less than a year. So for those of you that are addicted to tech stocks and Bitcoin, all that, again, these commodities can put some quick gains in your pocket. They might sound boring, but they can certainly move when they want to move. Okay, and then finally, you can see here just a beautiful bullish falling wedge pattern, and was pointed out back then with sugar at support as well. So these are old notes. August 9th, I pointed that out. The bullish falling wedge at key support. That was a golden buying up right there. We might have gone long. They might have clipped our stops. That's the thing. I keep stops relatively tight, but if you're swinging not for singles and doubles, which most of the swing trade ideas are, but you're looking to hit a grand slam or a home run, something along those lines, then take these longer term charts into consideration. Consider where this might end up, and then you can use much wider stops than some of the stops that when I'm targeting the quick moves up here. But that's sugar. Still looks constructive on this weekly chart. PPO still hanging above here on the above the zero line. And right now, what does it need? It needs a little jolt here. We need to clear out this recent area of consolidation right there. Obviously, if you take out each previous reaction high, especially this one here, that would be a pretty powerful buy signal and probably send sugar ripping on higher. And again, I think that might coincide with nervousness in the equity markets, money flowing back into these commodities. But there's also a fundamental case to be made right now with recent weather, a lot of flooding out west in the U.S. here that's sent corn and other grain prices higher. Here's sugar on a daily chart. We were just looking again at a weekly chart. So to kind of zoom in there, there's that recent downtrend line, if you will, at level we need to pop there. There was that's that same wedge, the support I said it fell to right there, divergent low. And this is common too with a lot of trades. Nat gas did it on a much shorter scale. Actually, natural gas didn't. I posted that today that the futures never did take out that previous low. UNG did slightly. That's so common to have a security come down, and then they'll take it just below the support level where it should, quote unquote, should bounce. Why? Many reasons, but largely I believe those are stop raids, triggered by the powers that be that want to run it down, clear out some longs, suck in some shorts, and then boom, you get the big reversal afterwards. So either way, that's essentially a reversal right at support. And again, that was the objective entry number one, to buy a pullback to well-defined support with divergence in place. Buy signal number two came on the breakout above the downtrend or the wedge pattern. And you can see right here, beautiful little, I pointed out at the time, head and shoulders topping pattern right there. There's your neckline. Love those head and shoulders. Boom, played out nice. That was the measured target right here. It actually played out to the measured target, had a nice bounce, rally from there, and then continued lower. So that's sugar. And again, right now, Is there a hard buy signal on it at this point? No. But again, watch these previous reaction highs. Maybe something you just want to layer into, scale into in the coming months. Again, if you're building up a portion of your portfolio into these various ag commodities. And they all have ETN. Most of these have ETNs, by the way. Sugar is SGG. Okay, I said the charts of sugar looked sweet, and so does wheat. Wheat looks good as well. This is, it was an active trade. It's still an unofficial trade. We hit our final target, and then I said, on the pullback, it looked good to get back into for the next thrust up, and I still believe that. I've shared this long term. It's a weekly chart, goes back to the late 90s, 1999, and the basis for the recent wheat trade, and reason it's still, I think, a portion makes sense for a portion of a long-term funds in a portfolio. This is a 3-decade plus long trend line. This goes back again to the 90s. This trend line, beautiful long-term uptrend line in wheat, and it's simple. You've been rewarded for decades buying pullbacks to buying wheat at pullbacks to this level. That's what we did right here. That was our entry right there. Stated March 12th and May 2nd. Wheat has fallen to long-term support while at rarely seen oversold levels on this weekly chart. We were oversold. Don't get oversold often. All these circles show you when we were oversold. Simple stuff, guys. I mean, in the long term, most people, I think, just lose focus and lose patience on these trades. And but you gotta, if you're taking a long-term view, and I've measured it out for you every time. These circles show you right here, every time, without exception. 0 exceptions that we hit that oversold level, the 30 or lower. Here's what we rallied: 52%, 45%, 36%, 46%. So far, as of the other day, only about 30%. So this time around, and that's why I think there's more upside in the wheat trade. And again, we exited very nice right at the first pullback. That was the first reaction. But again, you could have entered back and probably entered now. Again, at this point, I'll have to zero in on the 60-minute charts to try to identify an objective entry point. But again, you can either take a full position, that's usually what the official trade ideas are, or when I say something looks good longer term, like gold, layer in, scale in on pullbacks to support, or if the charts continue to firm up. It's not always about adding on weakness. On a good position, you want to add on strength. It shows you the trade is working in your direction. A lot of professional traders will do that. They add on strength instead of weakness. So that's wheat, and that's a long-term chart. Here's that wheat ETN right here, the trade again. So we took it, and this is how you use weekly charts and daily charts in conjunction. That weekly chart, we hit support back then. What was that, back in March? But we didn't really I couldn't make a strong case for a buy signal. Maybe there was a case made. Maybe we did go long. There was a downtrend. That would have showed better on the 60-minute chart. That would have been a little wedge, and that would have produced a trade. And I can't recall if we traded back then. I trade so many things. Probably I will certainly highlighted it. I covered that on the weekly chart. But this was the basis for this trade right here. Boom, nice downtrend line. Beautiful little bullish falling wedge pattern. Went in there, broke out, went up, hit the first target. Where was it? This was the first target right here. Second target, hit that third and final target. We got out, and at the point we pulled back to the T2, the second target, I mentioned that as an objective long entry for another thrust up, and you can see we've hit now that uppermost target for the near term. But again, I think whether we pull back again or not, I think there's more upside, and we'll finally break above that $6 level on wheat and continue on higher. Getting a little stretched now, so not the most objective time to add. PPOs at high level look like it's poised for turning down, so this one may need to consolidate, may or may not. Sometimes these commodities just keep running and defy overbought. Overbought just becomes more overbought. Sometimes they need to work this off, like coffee. Coffee's doing that right now. We'll get to that one here in a second. Okay, if you're still with me at this point, it's a long video. I know I'm covering, I'm hitting them all. I'm covering just about all the ag commodities, so I just figured get them all in one video. Coffee, probably should have covered up front. It's an official trade, an active trade right now, official trade as well. And you can see the chart. Again, this one goes back all the way into the late 90s. Simple wash, rinse, repeat stuff. Look for these trends. Look for a downtrend that ends with a divergent low. Again, I don't have all the annotations here. Bullish divergence right there. That marked this rally, and these are big, big trends. Actually, this has been more of a bull market for coffee than a bear market like a lot of the other ag commodities. But you can see just how well it trades to the technicals. Look at that uptrend line. Ended with a divergent high. Broke down. That was a big correction off that divergent high right there. Went on up. Made another run with a nice, very dangerously steep. You got to watch. The steeper a trend line on an up or down trend, usually the sharper the reversal. That was obviously the case here. That was a big, sharp, powerful correction. Ended in just a beautiful bullish falling wedge. We got it. We nailed. We were in there long officially at that one, right off the lows. Might have even zeroed in before the daily one broke out with a 60-minute chart. I can't recall, but we caught the bulk of that run up. Stayed long on it, and then it put in a divergent high. So we got out before that first high was overbought, waited it out, and then boom, that divergent high came in correction. So again, it just trades so well to the technicals, at least the way I chart things. Everybody's different, but this is my kind of chart. And so where we're at now, I know there's some frustration with the trade lately. Made it very clear when we hit the second price target that we're probably looking at a good chance for a pullback. And I know some got out. I got out and recycled back in. So where are we at with this one? All right, longer term, I still very much like it. Again, you can see big, powerful bullish divergence right here. This was the, and again, we're on a weekly chart. The trade itself on JO was on a daily chart, those targets and all that. But if you're taking a big picture view, here is a bullish falling wedge similar. Remember, nothing goes straight up. We had an initial run, and I want you to look at that pullback, that reaction right there. Oops, I messed it up. You might have to, I don't know if you can zoom in on the video, but there after the breakout, because it was a sharp move off the lows, there was a pretty decent correction right there. Same thing here. We had a very impulsive move off the divergent low, and we've had a correction recently, and that took us back to I forget where we're at now. I'll have to look at that trade in a second, but this to me looks very similar to that, and I'm still leaning towards another thrust up. And you can see, from where we're at, I can't remember if I put that 60% back here or down here, but I'm looking for a lot more upside in coffee. Doesn't guarantee we're going to get it. As much as I show you these past rips and dips and the way things have played out, by no means is there a guarantee. So you should not get married to this trade. I've traded long enough to know that or have learned that even the most beautiful setups, the best looking chart patterns, sometimes just don't play out. They're overrun by fundamentals or whatever reason, or maybe I just read the tea leaves wrong. So that's the thing is, I have an official stop on the trade which is above the recent lows, but if you're swinging for the fences on this one, you could certainly use a little more liberal stop if it's a long-term trade for you, and hold tight and try to capture one of these runs, or something like this run back here, or this run back here, or even this one right here. Here's my daily chart on coffee. And again, we're looking at the futures here on most of these, not the ETFs. If I go to those black charts, those are the ETNs. But remember, as I said on that NAS gas trade today, the ETNs, they do their best to track. And I'll tell you, coffee does a pretty good job. It's not leveraged or anything, but I just want to mention that that's where I really focus. I care more about a technical breakout here, or a stop that would be hit on coffee futures, more important than JO in my opinion, which isn't always going to do a perfect job. It'll do a good job, but not perfect. So there it is. There's your bullish falling wedge breakout, one thrust up. It would be rare to see a one and done rally like that. Possible, but usually you get a little kickback rally and at least another thrust up. Here we had a one and done, I will say that. But there was your secondary kickback rally, and then it went lower. So usually you don't see a straight up, straight down like that. Possible, but not very, very common. Next up, corn. Corn is going to move very much most of the time, not all the time, but very often it's going to move in near lockstep with wheat. So as I mentioned recently, we had the official trade on wheat. Had I added corn, it would have been a lot of overlap there. It's like buying SPY and QQQ. You know, you're either going to make money on both or you're going to lose on both, swing trading. So similar story, but again, it's if you want a piece of your portfolio, you want to do these individual commodities. CORN is also the ETN ticker. These are the corn futures. And what are we looking at here? This is a weekly chart. And so what stands out, again, I'll let you go look at the divergent lows and highs and you decide whether those were, you know, good buy signals and sell signals. That was your divergent low right there. That was your divergent high, divergent high, divergent high. Simple stuff. Right now we don't have that. We did have a divergent low right here, which was a buy signal, but what's happened since is corn has traded sideways, was locked sideways in a trading range, which it is just now starting to pop above. This is powerful. If we can continue to build on, hold these gains and build on that, that's a pretty powerful basing pattern, and I think that sends corn up here to my next, was a former resistance zone, now it's a target zone. So that would be the next stop for corn, right up there to maybe anywhere 525, 550 area. Be a decent move there, and maybe more from there, but as of now, that's what we're looking at. Okay, here's a chart of cotton. This is a weekly chart, long term, going back to about 2009 here. And you can see these lines, green, red means these are support resistance lines. If it's green below, it's support. If it's red above, it's resistance. So they change color depending on whether it's support or resistance. And so that's it. So you have cotton down around support, decent, pretty decent, not great, but a decent support level. Oversold. So you can see here, this is the first time the RSI has hit the 30 level since right here. We had that point, it ended in divergence. We had an oversold reading there that from the same exact level we're at today, and that proved to be a nice buy signal there. So again, it's not a hard buy on this one, and I'll tell you, a lot like the last chart I just showed you, what we're looking at corn, this is a multi-year basing pattern here. So my guess, or at least my trade here would be, you know, move up. Obviously there's resistance, and probably work our way back to the top of this trading range, and ultimately maybe look to position for a breakout and a much longer term buy signal. So whether that happens or not, what I can tell you with certainty is it's an objective long with a stop somewhat below that bottom of the range there. You either get stopped out or not, but the risk reward is attractive on cotton. And again, it could be a dead money trade for a while too. I'll have to study the charts a little further and consider adding that one. BAL, by the way, is the ETN for cotton. Here's what it looks like. This is cotton futures on the daily chart. I just showed you a weekly chart, and you can see here's that support level I was just showing you on the weekly. So it's not it's a good support level. We chop a little through it, so it's not super well defined. And again, we've chopped a little below it, just like we've chopped a little bit of it there, a little below it there. And you can also see what's nice about it and would make for a trade. Why I think this might be one of those fake out moves where they run you down. You can see that we have some divergence there. Right there. So it looks good. Again, a stop under the recent lows offers very minimal downside risk if stopped out, and quite a bit of upside potential. So not a bad idea. And again, for a piece of the pie, maybe you take a partial position now and you start building to that position. If the charts continue to firm up, you can always add to it. Oof, and that's it. There was one chart I was going to show you. It just compares commodities to the S&P 500. They used to have a high correlation, and they don't anymore. You know what? I'll show you that just because we're here. Might as well do it at this point. Yeah, this is it. This is a Bloomberg Commodity Index. Now this one has oil as well. In fact, energy is a big part of this index, so it's not the softs. We just went over all the soft commodities. We didn't cover any of the hard commodities. But you can see historically, because I wanted to hit this, because sometimes I'll get the question, hey Randy, if the stock market goes down, shouldn't commodities go down? Well, yeah, if you asked me a decade ago or beyond, yes, there was a very high correlation. You would think the economy is doing good, price of commodities go up, and vice versa. But ever since about 2011, and my guess it has to do with the massive amount. We've never seen such intervention in the financial markets and such distortions as we have since the Fed and all the global central banks started their quantitative easing program. So it really flipped things upside down, and you can see we went from a strong positive correlation. This is the S&P 500 down here, commodity index up here, to a negative correlation. In that negative correlation, there was a brief little pause there. That negative correlation persists today. So it's only logical to at least expect, or very possible, that the stock market tops out. We enter a bear market, and commodities can go into a bull market again, because that has been the trend, an inverse correlation with one going up and the other going down. All right, we'll wrap it up here. This is the longest video I ever made, but again, just because I wanted to hit it all, at least on that soft commodities, because they're all interrelated, very much so. And hope you enjoyed it. And if you have any questions again on it, just post a thing under this video, and I'll try to get back to. Sometimes I miss the comments, I miss the notifications. If that's the case, then drop me an email or bump me in the trading room if you're a gold member. If not, just shoot me an email if you're a silver member. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.